All right, let's dive into something a lot of folks find, well, kind of intimidating. Investing when the economy's taking a dip.
Yeah, economic downturn doesn't exactly sound like a party, does it?
Not really. But hey, maybe there's more to it, right? Like our sources this time, they frame these downturns not just as like panic mode, but also potential opportunity.
It's funny, right? Many folks retreat when things get shaky, but historically, those who stay put, even increase their stake, often come out stronger.
So this deep dive, we're figuring out those moves. Yeah. What are we working with here, sources-wise?
We got market data going way back. Different investment strategies analyzed, even some psychology, how our brains work when money's on the line, especially when times are uncertain. The takeaway, downturns. They make opportunities happen that just wouldn't exist if everything was hunky-dory.
I'm listening. Where do we even begin, though? Feels like a zillion ways to invest.
Let's kick it off with, consistency is key here, discipline. It's called dollar cost averaging. So instead of trying to time the market perfectly,
Which, let's be real, who can actually do that?
right, exactly. So with this, you invest a fixed amount, regular intervals, markets up, down, sideways, doesn't matter.
So even if news is all doom and gloom, recession this, recession that, I should just keep going with my regular contributions.
Might feel odd, but think of it like this. When prices drop, that fixed amount you're putting in, it buys more shares, units, whatever, like a bulk discount sale market-wide.
Hmm, okay. And then when things recover, which they tend to do eventually.
Those extra bits you snagged cheap, that's where it can get really interesting return-wise.
So less about outsmarting the market, more about steady as she goes.
You got it. And there's a mental side to this too. Automating those investments, less likely to do something rash out of fear. You're taking your emotions out of the equation. Super helpful when things are volatile.
Makes sense? Emotions and money. Not always the best combo. But what about investments that make money even when times are tough? Those high dividend stocks everyone's always talking about?
Ah, yes. High dividend stocks. They can be pretty attractive, especially if you want some passive income. Think about companies that provide stuff everyone needs no matter what the economy's doing.
Healthcare, utilities, that sort of thing.
Bingo. They tend to have more stable earnings even in recessions. Means they're more likely to keep paying out those dividends to shareholders.
So even if the stock price is bouncing around, I'm still getting that regular income. Feels safer when everything else is shaky. How do I know which companies are reliable with those payouts, though?
Research, my friend. Look for companies with a solid history of dividend payments, ideally ones that increase them over time. There are even indices tracking these, the dividend aristocrats.
So not just chasing the biggest yield, it's finding companies committed to sharing profits, even when things are tough.
You got it. Now, if you're really risk averse, capital preservation is your top priority, then consider bonds, government bonds especially.
Bonds. I need a little help with those. What makes them so special during a downturn?
Picture this. High quality government bonds, like those U.S. Treasury bonds. Think of them as the ultimate safe haven. They're backed by the government, so super low risk compared to stocks.
So if the market's tanking, my bonds are more likely to hold steady.
That's the general idea. Might not have the highest returns, but they provide that stability, that security when things are unpredictable.
Playing defense, riding out the storm, keeping my money safe until things recover. Got it. What if I want to be a bit more, proactive?
hmm
Capitalize on sectors that actually benefit from a downturn?
That's where sector investing comes in. A bit more targeted, betting on specific industries that could do well even when times are tough.
Wait, so not every sector reacts the same to an economic downturn.
Nope, not at all. Take the COVID pandemic, for example. Some sectors thrived, like tech, e-commerce, while others, like travel and hospitality, well, not so much. A smart sector investor might have spotted these trends early on and adjusted their portfolio accordingly.
Like a market detective looking for clues about which industries buck the trend.
Precisely. And to invest in sectors without picking individual stocks, you can use ETFs, exchange-traded funds. They're like baskets of stocks tracking specific sectors, giving you instant diversification.
Good tip. I've also heard a lot about value investing. Big Warren Buffett fans always talking about it. What's the deal with that, especially in downturns?
It's all about those hidden gems. Companies that are undervalued by the market compared to what they're truly worth. Downturns can create tons of opportunities for these value investors. Why? Because stock prices drop across the board. Often it doesn't even make sense.
So great companies can take a hit just because of the overall mood, not because they're doing poorly.
Exactly. And that's where the value investor jumps in. They see those drops as buying opportunities, scoop up shares of solid companies at a discount. Of course, this requires a lot of research, financial know-how. Got to make sure you're getting a bargain, not a lemon.
Not for the faint of heart then, but potentially big rewards if you have the expertise and patience.
You got it. Let's switch gears now. Something a bit more tangible, stable, especially during economic uncertainty. Real estate.
Real estate always felt a bit out of reach for me. Need a ton of money to get started, right?
That's a common misconception. Buying property directly does need a chunk of change up front. But there are other ways to invest in real estate without breaking the bank.
Like those REIT things I keep hearing about.
Exactly. Real estate investment trusts, REITs. They let you invest in real estate without actually owning property. Kind of like mutual funds for real estate, focusing on specific types, like commercial or residential. Plus, many REITs pay dividends, so you get steady income.
Get into the market without being a landlord. I like that.
And during a downturn, certain types of real estate can actually do better than others. Like we said, people always need a place to live, so residential properties tend to be more resilient.
Makes sense. But real estate isn't risk-free, right? Prices go up and down, renters aren't always reliable.
Of course, like any investment, there's risk and reward. Got to consider your goals, how much risk you're comfortable with, your overall strategy. But for those who do their homework, understand the risks, and are in it for the long haul, real estate can be a valuable part of a diverse portfolio, even during a recession.
Before we go further, I think there's one more concept that gets overlooked, but it's super valuable during a downturn. Liquidity and cash reserves.
Absolutely. Liquidity is how easily you can turn an asset into cash. Cash itself is the most liquid, obviously, always ready to spend or invest.
So a stock would be less liquid because you have to sell it first, which takes time and might cost you.
Exactly. And during a downturn, having a good chunk of cash can be a big advantage. Gives you flexibility to jump on those unique opportunities that pop up.
Like what kinds of opportunities?
Let's say a major stock index plummets 20% overnight. Crazy global event, something like that. Having cash lets you buy at that low price, potentially making a nice profit when things rebound. Or maybe a great property goes on sale cheap because the seller's in a cheap spot. Cash lets you act fast when others can't.
So it's not just about weathering the storm. It's about being ready to make moves when those opportunities appear.
You got it. Cash is king in those situations. Gives you options, lets you be strategic when others are frozen with fear or just don't have the funds.
Wow, we've covered a lot. Dollar cost averaging, high dividend stocks, bonds, sector investing, value investing, real estate, and now liquidity. It's clear there's no single answer to investing during a downturn.
Right. Every strategy has its good and bad points, risks, and potential rewards. It's all about finding what fits you, your situation, your goals, how much risk you're okay with, and how long you plan to invest.
No magic formula then. Got it. But how do I figure out which strategy or combination of strategies works for me? That's what I'm still trying to figure out.
Well, that's where a little introspection comes in handy. Maybe some advice from a pro, if you're into that. It's like putting a puzzle together, you know?
Yeah.
Got to figure out which pieces fit your picture.
Okay, I get the analogy, but honestly, still a bit fuzzy on how it all plays out when things actually go south. Like in a real downturn, can we, I don't know, walk through an example?
Sure, let's paint a picture. Classic recession vibes, consumer confidence, down in the dumps, businesses, holding back, not investing, and the stock market, reflecting all that uncertainty, prices dropping.
Yikes. Sounds familiar from, well, pretty much every news cycle at some point. So what's our dollar cost averaging person doing in this mess?
Sticking to the plan. Same fixed amount, regular intervals, every month, quarter, whatever they set. But here's the thing, as prices fall, they're buying more with each payment, taking advantage of everyone else's pessimism.
So no crystal ball trying to guess the absolute bottom. Just consistent buying no matter what the daily ups and downs are.
Exactly. And when the market bounces back, which history says it will, they're in a prime spot to benefit from all those shares they picked up cheap.
Okay, makes sense. What about our high dividend friend? How are they handling this recession storm?
They're probably doubling down on those steady sectors we talked about, utilities, consumer staples, healthcare, those companies that provide the essentials, the stuff people always need, good times or bad.
So their portfolio might be up and down with the market overall, but they're still getting that regular income from the dividends. Must feel pretty good when everything else is so uncertain.
Absolutely. And depending on their risk tolerance, they might even take those dividends and reinvest them, buy even more shares at those lower prices, boosting their potential gains even further down the line.
Okay, I see how that can work for both income and growth. Now, what about our bond person? Where's their safe haven in all this?
Shifting a good chunk of their portfolio to those high-quality government bonds we discussed. Remember, the ultimate safe haven, especially when things are economically stressful.
Because they're government-backed, like so low risk, right?
You got it. Returns might not be huge compared to stocks, but stability, preserving their capital, that's the priority during a downturn. Safety over chasing those big gains.
Makes sense if you're really risk-averse or just want to protect what you've saved from all that volatility. Now, the sector investor, what are they up to during our recession here?
They're putting on their thinking cap, trying to figure out which sectors might actually benefit from all this.
Wait, some sectors do good during a downturn? Seems kind of backwards.
It can seem that way, but every economic cycle creates winners and losers, right? Think about it. Recession hits, discount stores, they often do better, people watching their wallets. Or certain kinds of healthcare. Demands might go UP, people prioritize staying healthy even when cutting back elsewhere.
So looking for those bright spots, the opportunities that pop up even when things are gloomy overall.
You got it. Trying to figure out which industries will buck the trend and position their portfolio accordingly. And remember those ETFs. They can be super useful to get into a specific sector without having to pick individual stocks.
Right, good point. Now, what about the value investor? Is this their time to shine, snagging all those bargains they love?
Oh, they're probably pretty happy. Remember, they thrive when the market's being irrational, when fear and panic drive prices down for no good reason. This is their chance to buy great companies cheap, knowing that eventually the market will catch up and realize their true value.
So doing their homework, looking at financial statements, finding companies that have been unfairly punished by all the negativity.
Exactly. Looking for strong fundamentals, good management, a clear reason why the current price just doesn't make sense.
Sounds like a mix of art and science, finding those hidden gems.
It is. Takes patience, discipline, and a strong stomach for all the ups and downs. Not everyone's cut out for it, but it can be very rewarding for those who stick to their guns.
So what about our real estate investor? Braving the recession or sitting it out?
Maybe selectively investing, Understanding that not all properties react the same to a downturn.
So what would they be looking at in this situation?
Well, we talked about how residential real estate tends to be more resilient. People always need a place to live, after all. They might also look for places with growing populations, strong rental markets. Those factors can help offset the economic wobbles.
So strategy matters. Got to understand how different real estate markets work. But even with a plan, there are still risks, right?
Of course. Property values can change, renters aren't always reliable, and managing properties can be a pain, especially during tough times. But for those who do their research, understand the risks, and are in it for the long term, real estate can be a good addition to a diversified portfolio, even during a recession.
Okay, so we've seen how our different investors handle this hypothetical recession. Different strategies, different approaches, all based on their own situation and what they're aiming for. Now, what about our cash-loving friend? What are they doing with all that liquidity while everyone else is freaking out?
Watching, waiting, planning their next move. Remember, cash during a downturn. It's a powerful tool, gives you the flexibility to jump on opportunities that others might miss.
So not just sitting on the sidelines, they're actively looking for the right time to put that cash to work.
Exactly. Maybe a great company's stock gets hammered by the recession, or a fantastic property goes on sale cheap because the seller's desperate. Having cash means they can grab those deals and potentially make a killing when the market recovers.
Not afraid of the downturn, using it to their advantage. Buy low, sell high later on.
Precisely. They understand that downturns create volatility, and volatility, while scary, can also create opportunities. It's about having the guts to act when others hesitate, to see the potential even when things look bleak.
This whole scenario has been really helpful. I'm starting to get how these different strategies work in the real world, how each has its own strengths and weaknesses. But gotta ask, you mentioned common pitfalls before. What should people be extra careful about during a downturn?
Great question. And that's exactly what we're going to dig into in part 3 of our deep dive. We'll look at those pitfalls, how to avoid them, and give you even more insights to navigate investing in these tough times.
Looking forward to it. Can't wait to wrap up our exploration of investing during downturns. Back for the final part of our deep dive, investing during downturns. We've looked at strategies, played out some scenarios, but got to talk about those pitfalls now, those things that can trip even the smartest investors up.
Oh, absolutely. Downturns, breeding ground for mistakes, money and emotions. Not a good mix, especially when it feels like everything's crashing down.
So what's the big one? The number one trap investors should watch out for.
Letting fear take the wheel, panicking. It's easy to get sucked into those doom and gloom headlines, right? Then you make a rash decision, sell everything off because you think it's the end of the world, financially speaking.
That fight or flight instinct kicks in. But in investing, running away usually means locking in those losses, missing out when things turn around.
Exactly. Got to remember, downturns, they're part of the cycle. The market always recovers eventually. Panicking, selling at the bottom, guarantees you'll miss the upswing when it comes.
So keep a cool head, focus on the long game, don't let those daily ups and downs derail everything.
You got it. Another one. Not diversifying enough. Putting all your eggs in one basket amplifies your losses if that investment goes sour, especially during a downturn.
Don't bet the farm on one horse. Spread things around, different types of investments, sectors, even different parts of the world. Helps cushion the blow if one area is struggling.
Diversification 101. Super important always, but even more so when things are uncertain. Here's another one. Trying to be a market psychic.
Yeah. Buy low, sell high. The dream, right. But isn't that what everyone's trying to do?
Seems that way, but consistently timing the market. Almost impossible, even for the pros. Predicting the exact bottom or top. More like gambling than investing.
So what's the alternative?
Time in the market, not timing the market. Invest regularly, be disciplined, ride those waves. The market usually rewards those who are patient and stay in it for the long run.
Focus on what you can control, right? Your strategy, your savings, your diversification. Let go of the stuff you can't, like what the market decides to do on any given day.
Exactly. And this one's more mental than anything. Getting caught up in the short term. Those daily headlines, the little swings, the constant information overload. Investing. It's a marathon, not a sprint.
You can't get discouraged by every little bump in the road.
Don't let the short-term stuff mess with your long-term vision. Keep your eyes on the prize, your goals. Fluctuations happen, don't overreact.
Have a plan, stick to it, trust the process. But let's be real, downturns are tough emotionally. Seeing your portfolio shrink, everyone around you freaking out.
It's hard. That's why it's so important to have support. A financial advisor if you use one, a friend, or even just other investors going through the same thing. Talk it out. Get those fears out in the open. Get an objective view.
Like having a coach in your corner, keeping you focused on the big picture when things get rough.
Exactly. One last thing to remember. Downturns. Yeah, they're tough, but they can also be chances to grow, to learn, reevaluate your portfolio, figure out how much risk you're really comfortable with, maybe even find new strategies you hadn't considered before.
What doesn't kill you makes you stronger.
Right.
A downturn can test you, but it can also make you tougher, smarter, and ultimately more successful as an investor.
Couldn't agree more. Embrace the challenge, learn from it, and come out the other side ready for whatever the market throws at you next.
Great stuff. I think we've really covered the bases here. Those core strategies, how they work in the real world, and now those pitfalls to watch out for. Our listeners have a pretty solid toolkit now for navigating these tricky times.
Absolutely. Personalize your approach. Figure out your own risk tolerance, your goals, and never stop learning. The more you know, the better you'll be at weathering any financial storm.
So true. And one final thought for our listeners. Don't let fear shut you down. Downturns are a fact of life, but they can be overcome. Approach them strategically, keep learning, and have a bit of patience. You'll not only survive, but potentially thrive in the long run.
Couldn't have said it better myself. And on that note, thanks for joining us on this deep dive. Keep exploring these ideas, keep asking questions, keep learning. The more you know, the better your financial decisions will be, no matter what the economy's doing.
And as always, we'd love to hear from you. Got ideas for future deep dives, resources you want us to check out? Let us know. Until next time, happy investing.